I would say it's around 50-50 on people if even think about doing a 1031 exchange. I think they're so focused on the transaction that they really need a good tax strategist to help implement the kind of tax savings that a 1031 could help you realize. And further from that, even the half that do talk about a 1031 exchange, they don't know all the intricacies.
Talked to a client, looked at her situation, and she had about $120,000 capital gain, but she had over $200,000 of loss carry forward from previous properties, which meant that she didn't even need to do a 1031 exchange in order to not have to pay capital gains tax. She could have just sold the property and use her loss carry forwards. Hey, welcome back to the show, Billy. Second time, first person to ever be on the Learn Like a CPA podcast twice. Would you briefly give the audience an intro of who you are?
Yeah, I'm honored to be back. I have been helping real estate investors for over 10 years with, taxes and accounting, and it's just something I'm passionate about, so I'm glad to be back speaking about other tax strategies that we can help our clients implement.
Yeah, and one of the strategies that we're going to talk a lot about today is the 1031 exchange, and kind of instead of just doing a glance over, there's a lot of bad education out there, I feel, around the 1031 exchange. I don't think it actually gets enough focus that it needs to. And so we're going to kind of talk about the good, the bad, the ugly today. Is that the number one go-to move that a lot of people look to make, or in your experience, what are people not seeing?
So in my experience, I would say it's around 50-50 on people if even think about doing a 1031 exchange. I think they're so focused on the transaction that they really need a good tax strategist to help implement the kind of tax savings that a 1031 could help you realize. And further from that, even the half that do talk about a 1031 exchange, they don't know all the intricacies and the different strategies that you can use when you are, thinking forward, especially in a strategic way, to help you implement all the different kinds, like a construction exchange or reverse exchange, things like that. So I wanted to make sure that we hit on those so that people have a point of reference for that.
And to take it a step back, if they even need to do one, right?
Exactly.
So I was talking to somebody a few weeks ago, and this was one of my emails to my email list was, you may not even need to do one. I talked to a client, looked at her situation, and she had about $120,000 capital gain, but she had over $200,000 of loss carry forward from previous properties, which meant that she didn't even need to do a 1031 exchange in order to not have to pay capital gains tax. She could have just sold the property and use her loss carry forward. So a lot of people aren't looking at things like that. They're just saying, okay, this is what I hear that everybody does. Let me just continue to do this. And obviously we don't know where tax rates are going to be in the future. And deferring that tax liability down the road will probably make sense for most people, but you never know. You could be in a higher tax bracket in the future. Maybe the capital gains rate is higher in the future. They've talked about eliminating the step-up in basis. They've talked about eliminating all that stuff. So we'll go to the regular 1031 exchange. Kind of what does that look like, that process?
Definitely. So an important factor in the 1031 exchange process is if you're considering selling a property and considering exchanging, you need to work with a qualified intermediary. That's definitely one of the big steps. The next big step is understanding the timeline. So you have 45 days to identify your replacement properties and 6 months to close. And from there, that's, I would say, pretty much the basics is inviting that third party into the transaction with the qualified intermediary, and then making sure you understand the timelines.
And for the identification, they can identify up to 3 properties or 200% of the fair market value from the sale, right? Is there anything else I'm missing?
I believe that covers it.
And so what happens if they identify but they don't close within the 6 months? Then
it's what we call a failed exchange, and from there you kind of got to scramble and figure out, do you have the loss carry forwards to cover you? Do you need to come up out of pocket with an estimated payment? And the problem is if you're close to the end of the tax year, that it kind of, if the 6 months straddles year end, you could be in a situation where you have a tax bill for the prior year that you weren't planning on.
Yeah, and that's what I tell people too, especially as we're coming up close to the year is over. You really have to, the closer you get to the end of the year, the harder it is to really sell tax efficiently, because if you botch that 1031 exchange, you're gonna have a tax bill. So closer to the end of the year, I try to stay away from them unless you absolutely sure that you can go through with it. Depending on the market right now, I would say right now you could probably go through a 1031 exchange fairly easy as a seller, because there's not as much competition versus when interest rates were super low and people were paying over asking price in cash. It was a lot harder to facilitate a 1031 because by the time you identified those properties, they were probably already bought. And so let's talk about see, that was interesting. So there's the 1031 exchange, and then you said there's the construction exchange. What does that look like?
So if you understand already that the property you want to acquire needs a lot of work, there is a way to work with the qualified intermediary to build those improvements into the exchange. An example I've seen with a client is, they had 6 months or so, because you have to adhere to the timelines to get a project done. The build took about 8 months. So at that 6-month deadline, you have to say, did I satisfy the exchange? Did I use the funds that I needed to use? But if you know you're going into a value add property, it's basically the construction exchange would be a way of kind of creative financing that process and being able to say, I have these builds that I need to make. Let's work it into the process and execute a construction exchange, rather than saying I need to go replace in my portfolio something that's rent ready day one.
Mm-hmm. And what does the reverse 1031 exchange look like?
So the reverse 1031 exchange, I would also say, is kind of another creative financing strategy where you identify the property that you want to have replaced already, and you go into close with that property and acquire it, and then you, in the reverse, sell a property out of your portfolio to help satisfy the exchange and use those funds to kind of pay yourself back. So it's a little bit more difficult to execute, and it involves a little bit more intricacy, but at the end of the day, like you said, if you come up with a deal that's too good to pass up, you're able to say, I know I want to go out and get this deal, and how can I get it done? I'll subsequently sell something out of my current portfolio to execute the reverse exchange.
Yeah, and I have an episode on December 12th, 2022 that talks about all the strategies that you can utilize to get out of a capital gain, 1031 exchange being one of them, syndications and other types of investments being other strategies. But is sometimes the right play to just pay the tax bill and move forward?
There are scenarios where that makes sense, I think.
Hey guys, just want to interrupt the podcast to let you know that if you enjoy the podcast and the content that's in it, you would love my Tax Strategy Academy. This is going to give you the framework for developing all your tax plans for the entire year, whether you're a long-term rental, short-term rental investor. You're going to get a one-on-one call with me to map out your tax plan, and you're going to get access to weekly office hours where you can come and ask your personal questions. So if you're interested in learning more, go check out the link in the show notes below. And now back to the show.
There are scenarios where that makes sense. I think if you're constantly reevaluating your portfolio and saying, not only what tax strategies are there here, but what opportunities are there to realize more cash flow on similar cash outlays, I think it's just a tool that you need to account for just to avoid having a tax bill. Because if you're going to be leveraging up your portfolio, as you should be, it's just a tool that you're going to want to use, whether or not you need to use it. For example, if you have enough passive losses, something like that. And it's going to be especially important if they don't do anything with bonus depreciation. I expect they will go back to 100% bonus depreciation, but if they don't, and bonus depreciation goes away, the 1031 exchange will become more crucial, because it will be harder to do the lazy 1031, which is, of course, doing a cost segregation study on the replacement property.
So I'm curious, why do you think bonus depreciation will come back?
I think it's going to be somebody's going to want to take credit for boosting the economy, and the best way to do that is, through tax write-offs, being able to say, if I go out and buy a truck and deduct it 100%, then that's going to be a boon for the economy, versus if I can only write off half of it, that changes people's perspective and they might hold on to their cash.
Yeah, and I think also too, the 1031 exchange, it kind of really depends on the individual too. If they say, hey, I want to get out of this investment, but I really don't want to do any more work, there's no way you're going to be able to do that really, unless you sell the property and pay the cash, because you're always going to, even if you went through the poor man's exchange, which we won't talk about on the podcast, but if you want to go back to December 12th episode, I explain it very well. They still have to buy something else.
Right.
And so if we're working with clients in their 50s, ready to retire, they don't want to buy other property. Sometimes it is, hey, let's sell it when you don't have any more W-2 income, so you're just in an overall lower tax environment, and then keep the cash. And also, right now, especially with interest rates and how the economy is going, that might be the best decision, is to just figure out what your tax bill is and kind of set that aside when you go to sell it, so that way you're prepared. So we talked a little bit about before about some other alternative investments. So, I do campgrounds and RV parks, and of course those losses to me are considered passive. So I could even use some of those losses to offset some other passive income that I have from my portfolio. What are some other alternative investments that people can utilize? Do you want to talk about car washes, self-storage, oil and gas? What do you want to talk about today?
Definitely. So I've learned that there is still somewhat of a lack of knowledge out there about the oil and gas investments. The most recent example is I had a client where they sent me a K1 thinking that they were going to have a bunch of losses from their oil and gas, but the tax preparer marked it as that the client was a limited partner, which means that they're not entitled to the tax benefits of oil and gas. So that's why I wanted to bring it up. But in a nutshell, an oil and gas investment is basically where you can sign on to an investment as a general partner and give them a lump of cash, usually $50,000 to $100,000. And then what they're able to do is go explore their asset for oil and gas reserves. And so it's kind of a crapshoot. It's a very risky investment. But what happens is you get to say, I'm going to give you $50,000 to go find oil and gas. You're going to help me write that off for my taxes because those exploratory costs that you incur are deductible for me. They're not subject to passive activity loss rules because I'm a general partner in the deal. And if they happen to find oil and gas, that's where the payoff comes in. They're able to, return your investment through selling off whatever oil they find. But it's risky because if they don't find any oil or if it's not as fruitful as they hope, your investment could be lost. So you bear all the risk, but it's a great way to say, I need to get rid of this cash. I want to write it off my taxes. And as a result, you can make that investment pretty easily without having to lift too many fingers. So.
Okay, so here's my problem with that. So the ones that I've seen, they when they go to file the paperwork, they mark you as a general partner. And then after year 2, they switch you to a limited partner.
Interesting.
How does that fly?
Well, that's a good question. I think that... that's a stumper. I mean, we do it all the time with short-term rentals and changing the activity level that you participate in. As far as oil and gas is concerned, I would defer to their tax preparer and their understanding of the laws and regulations and things like that. But at the same time, I would think that the partnership audit risk is going to be bared by whoever is putting the deal together and the way that it's written.
Mm-hmm. But either way, even if you're not marked, let's say you're investing money in oil and gas, and even if you're not marked as a general partner or active, it's still a PAL, right? And so you could use that to offset rental income.
Yeah.
So what about one of those, the donor advised fund? So I have my take on that. I think it's an awesome strategy, but did you want to explain it?
Yeah, basically the donor advised fund is for people who plan on giving their money away to charitable organizations anyway. I think it's a really great strategy to say, what can I sell on my portfolio and then buy it back with cash so that I can get an appreciation on the investment with being able to couple that with a tax write-off. And it's just one of those things that, again, if you're going to give the money away anyway and you're working with a tax strategist, it's something you get to do at the year end to say, I'm going to do something with this cash for my taxes that also I was going to do anyway, but it allows me to write it off and get a step up in basis.
And what you said there is really important, because if you were going to do it anyway,
exactly,
because a lot of times people will say, hey, what can I do in my life that's going to help me save money on taxes? When I think our job is to, okay, what are you already doing already that you're going to do anyways? So let's see how we can make that more tax efficient. So in this particular strategy, what you're doing is you're pretty much donating the fair market value of your stock or your taxable brokerage account to a charity, right? And then that you're going to get a deduction worth the fair market value of whatever the stock that you donated is. And if on the same time, the amount that you're donating, you're also replenishing your brokerage account with cash, what happens is your cost basis eventually one day will equal your fair market value of the stock account. And that's when you can sell it and pretty much liquidate your brokerage account completely tax-free. So exactly.
It's a opportunity for you to say, can I get a step up in basis on this stock and part with this cash versus parting with the cash as a donation because, again, you were going to do it anyway, and then now having to liquidate your stock account, which is going to be taxable if you do it the wrong way. So it's very important to keep track of and strategize around.
Are there any other strategies that we're missing when it comes to alternative investments?
Well, I like that you mentioned self-storage. I think as if bonus depreciation goes away, which I'm not convinced that it will, but if bonus depreciation goes away, you're going to have to find investments that allow you more opportunity to write things off personal property wise, things like that, because as you go in and just have less effective or more components in, say, a multifamily asset, something like that aren't as beneficial to depreciation wise, multifamily is going to be less of a sweet investment for you, even if they are doing a cost segregation study. So you kind of got to think about, what other assets can I invest in that are component heavy, or do I need to invest in a business instead, something like that, where I can utilize 179 or these other strategies, just because what we've been doing since 2017, the Tax Cuts and Jobs Act, is saying I'm going to buy a multifamily asset, do a cost segregation study, get a huge write-off as a result. That's going to be harder and harder to do if bonus depreciation goes away.
Yeah, and you brought up a good point there, because what I also talk about too is if bonus depreciation goes away, I think the self-directed IRA becomes a little bit more popular, because it's just a way to still invest into real estate and defer or mitigate, reduce that overall tax exposure. So, expect to see 1031 exchanges and self-directed IRAs and self-storage alternative investments pick up if bonus depreciation phases out. But we think that they will extend it, or at least we hope so anyway.
I hope so too.
Well, thanks for coming on to the show today. Where can listeners of the podcast find you?
Definitely. So check out our website, www.summitats.com, or you can always email hello@summitats.com, and we will get back to you. But it was my pleasure to talk with you about these important items.
Awesome.